Hey everyone, welcome back to another episode of Scale My Portfolio. Today we're going to be talking about a really interesting concept, especially for uh, the young ones out there, the Gen Zers, the millennials, those trying to enter the market. We're going to be talking about the guarantor strategy, all things you need to know guarantor related. And hopefully by the end of this video, you'll be able to leverage your privilege and get into the property market. Today, I'm really excited to have on board Imti to help us discuss this topic. Imti is an awesome mortgage broker, has helped heaps of clients build and scale their portfolio. Specifically in relation to this strategy, we've worked on a few deals together. Uh, Imti, do you want to tell everybody about yourself before I carry on rambling?
Yeah, no, of course. Thanks, Arshad. I think you hit the nail on the head. So I run a mortgage broking business, Hack Mortgages. We specialize in residential investment clients, in particular the under 40s, which is where I think we do a lot of our business together, and a lot of first home buyers and first time investors who use guarantees pretty much every single day.
Beautiful, beautiful. All right, let's get straight into it, Imti. So we'll start off with the usual, talking about what we'll cover today. With all of these videos, the way we go is we start off very basic, then we go more in depth, and then we tie it off with examples. So we'll pretty much be doing the same today. We'll talk about what is a guarantor, different types of guarantors, when can you use a guarantor, so just the basic information. Then we'll jump into the more strategic elements of it, right? Like, what are the risks of using a guarantor? What are the advantages, disadvantages? And how should you actually use this guarantor phenomenon in a way that you can use it to enter the property market early, scale your portfolio, or just help achieve your goals quicker and easier, right? So basically information and then strategy. And finally, we'll end it off with an example, a client story that MT and I have worked on together in relation to this particular concept. MT, was there anything else that we were going to cover that I didn't mention over here, or?
No, hit the nail on the head. I think really excited to dive into this. There's a lot of myths out there around guarantees, which I'm keen to jump in and dispel with you, but also some really good nuggets of gold in terms of using it to get into the market and really set yourself 5, 10 years ahead.
Beautiful. Yeah, I like that word myths because a lot of people they don't use the guarantor strategy or just don't use guarantors because they're afraid of the implications of it, which if you don't know much about it, it can seem a bit daunting, seem a bit scary, seem like something that the risks are pretty high. But when you actually go into things and look at how guarantors function here in Australia and how the banks treat it, it's actually pretty low risk, which we'll get into. And a lot of these myths that people have around it are more just things that happen in America. And like, you've watched some TikTok short about how an 85-year-old
Yeah. They've kicked
grandma.
down your door, they've stolen your dog, they've stolen your house, and yeah, n none of that definitely happens here. So yeah, definitely keen to
Yeah,
jump into some myths.
nah. For Australian banks are a lot nicer than American. So I'm not gonna come here to talk about them being really nice. I'm pretty sure I get roasted in the comments. But comparatively, a lot more reasonable and have like more uh reasonable procedures. Anyway, let's not beat that. Let's talk about very quickly before we get into it. Obviously, we have to flag this in every episode that these are not this is not personalized advice. These are financial educational concepts that we're discussing. So please take a moment to read that over there. You'll see that it says, that pretty much says what we've flagged already. So take a moment, quickly read that, and make sure you understand that this is not personalized advice. All right, let's jump into it. So let's talk about very quickly, very briefly, what is the definition of a guarantor, right? So a very basic dictionary definition is a guarantor is an entity that uses their own collateral to guarantee that if another entity's loan defaults, they will cover it, right? So that's from a like a very dictionary definition. Do you want to talk more about an actual definition from a lending loan perspective, MT? Like, how do the banks define it?
Yeah, of course. So let's talk practical definition. I think the thing with Guarantor, it can scare people a little bit in terms of when you look at it in a legal sense. That wording looks very intimidating. The way that I explain it to clients, in particular parents, is that all you're doing is providing a supporting security to your child or whoever's purchasing a property. Running example, if you're going to be purchasing property A, your parents will then just provide security over part of property B to help you secure your purchase. And I think that's the easiest way to look at it in terms of a practical sense.
Beautiful. Okay. And I think that's a pretty nice transition into the next slide over here, right? The different types of guarantor. I think take a moment to
Love the
have a
meme. Yep.
at me.
I'm here for it.
I'm proud of it. I feel like slipping in these memes, good way to keep people engaged. Plus, it's a good way to convince myself I'm doing work when I'm making memes. So, yeah. Anyway, security guarantor. This is the most popular type, right? So this is pretty much the one that you talked about, where your guarantor, which usually is your parents, but can be others, which we'll talk about later, use their collateral, their equity, whatever it is, to help you purchase your property without any cash, right? Or with much
Mhm.
less cash, because they're acting as a guarantor, such that if you default on the loan, they will they will help out with it, or they'll have some liability in it, right? So again, you can get 100 to 105% loan, not just to cover the property, but cover some of the additional costs that come with the property, acquisition cost, stamp duty, conveyancing, so on and so forth. Yeah. Do you want to talk to this security guarantor a little bit more? Because obviously this is the most popular type of
Mhm.
guarantor that we see out there that a lot of people go for. Tell us a bit more about it.
Yeah, sure. I think it's the guarantor product that 99% of the market will use. The big thing for me is that the way to look at it is it's your way into the market without needing to save a deposit. And when we're talking about property prices at the moment, all over the country, but in particular Sydney and Melbourne, and now even, Brisbane, Adelaide, Perth are starting to peak considerably. It's harder and harder for people to enter the market because they're struggling to save a deposit. What's happening in the current environment is that the market property prices are raising quicker than people can save cash in the bank. And so
Exactly.
as time goes by, people are ending further and further apart. So instead of, I know for some parents, they don't want to gift their child a 20% deposit, 250,000, $300,000 cash. This is actually a good way where parents who, have been in the market for a really long time can support their kids or, their relatives to get into the market without actually handing over any cash and stop them from being locked out. Because I think the further into the future we go, it's going to get more and more difficult to enter the market just by saving a cash deposit, in particular in capital cities.
Exactly. And I think it's that idea of continuously playing catch up, right? It's 2015, you're in Brisbane, Sydney, whatever city you're in, and you're like, okay, this area that I want to live in, I need 150K cash to purchase, right? You aggressively save. It's 2018, you're like, I got the 150K cash. I got the deposit to go buy the home that I want to buy. And then you look at property prices and you're like, oh my God, now I need 250K. And
Mhm.
then you go, and I literally saw a Facebook post about this the other day in one of I can't remember what group it was, but one of these property groups. I know me, you, we're all in a bunch of them, right? And it was literally a post where uh, a young lady was talking about how she's just been stuck for the last 5 to 6 years, playing catch up, right? And obviously there are other strategies around this, like maybe thinking about rent vesting or just reconfiguring your what you want to be more reasonable and starting off in a lower end market, if maybe further out or townhouse or whatever it is. But if you have this strategy available to you, then it's kind of like, why not, right? It helps you get what you want with no real like major disadvantages, which we'll talk about. So yeah, it's I think the big thing is it gets you around this playing catch up phenomenon, right? Next, so let's quickly touch base on servicing guarantor. Definitely less popular because of its the strictness and the difficulty to get it. But do you want to quickly touch on how it works, and we'll go from there.
Yeah, sure. I think this is probably the first myth that we'll debunk as we go through this process with each other. The the security guarantor helps you from a deposit perspective. The servicing guarantor is something that if you can't actually meet, let's say, the lending amount that you need to purchase a property, a servicing guarantor can come in over the top to say that, if you're unable to meet, let's say, repayments on an $800,000 loan, they'll step in and they'll make the repayments for you. Now, with servicing guarantors, 5, 10 years ago, they were a lot more available and readily used. Now, because of compliance issues and lending laws and the ever-changing landscape that we're in, it's very, very rare to end up with a servicing guarantor because essentially they're co-buying the property. They're not really a guarantor.
Yeah.
In saying that, there is a couple lenders that will do them, but they're on a case-by-case basis, and you're talking, your parents probably have to have a combined income of $1 million
Yeah.
for a bank's, individual department to even consider it. So I think it's a good myth to debunk that a lot of people, when they think of guarantors and guarantees. They think servicing guarantor can fix my borrowing capacity problems when really in today's day and age, it's you're using a security guarantor to fix your deposit problem.
Exactly. Yeah. No, that's good insight. I think probably a good takeaway is getting on phone with mom and dad and telling them to work harder, increase their income. Not as be like, why aren't you making
Yeah.
1 million?
What,
Yeah,
why aren't
but
you why aren't you a thoracic surgeon, mum?
exactly. Yeah. I think like we're not going to talk about it in this video, but there are other creative ways that we've helped clients with to extend their lending capacity or even leverage those relationships in that they have that are not through like a guaranteed direction, but things like co-borrowing, things like setting up a family trust, and basically having a more collaborative portfolio building strategy with your family compared to like each person building their own portfolio. Obviously, that comes with its pros and cons of family dynamics. So it's definitely something to think about in terms of what you want. But yeah, it's just something I thought I'd mention. Anyway, let's move on and let's talk about when can you use a guarantor, right? So, like we mentioned, servicing guarantor very, very difficult to get. No, sorry, I don't know what happened there. Servicing guarantor, very difficult to get. Parents have to be, or guarantors have to be like extremely high net worth. What about security guarantor? How feasible, how plausible is that?
hmm Great question. I think it's very plausible and accessible more than people think. I think, again, another myth is that people believe that their parents' house has to be fully paid off for them to go guarantor, which isn't the case. So long as there's enough equity in the property and your parents or whoever's providing the guarantees in a sound financial position, more often than not, if you're able to service the debt, we can organize a guarantee for you. But I think that's one of the big myths is that, oh, my parents still have a mortgage, they can't go guarantor. Not the case. Definitely can get looked at. And more often than not, most of the guarantee deals that I do are with clients who do have their parents still have an outstanding mortgage. I think the biggest thing to consider also is usually the parents have been in the house for a pretty long time. It was the family home. It's appreciated a lot over a long period of time. So there is that significant amount of equity that can actually be used for a guarantee. Now, when we talk about in what instances can it be used, banks prefer to help use it as a tool to help first home buyers. but that doesn't mean buying your principal place of residence only. So that's another myth, that they'll only do it for you if you're buying your home. Believe it or not, it's actually a really good way to get into the investment market, in particular if you're rent vesting or free vesting, so still living at home. I think one of the winning plays that we've seen is siblings going in on an investment property together, and mum and dad have been a guarantor for them. It's another way that people are going outside of the box to get into the market. In terms of, I guess, the investment side of things as well, it's a really great way to kind of contain those costs, and have cash in the bank for a risk, for essentially a risk management and a rainy day. I think one of the biggest traps that I see a lot of first home buyers and first home investors get into is they'll put every dollar that they have into the purchase, and then when something goes wrong, they're stuck, especially if it's an investment property or a first home, something's going to break. You're going to end up at Bunnings. You're going to need to call a plumber. You need to have cash in the bank to manage those situations. So I think it's a great way for, prospective home buyers to jump into the market, keep cash in the bank, and then just focus on paying down that home loan.
Beautiful. Awesome. Now, I think that's really good insight. So maybe if I were to distill that into like a simple question,
Mhm.
what do you think for the people watching this today who don't have their first home, or don't have an investment, just pretty much don't have a portfolio at all, uh, what do you think a minimum scenario they should have to reach out to you, to discuss the possibility of, getting a guarantor should be?
hmm I think 30,000 is probably a good safe number, in terms of cash in the bank. At least at that point, you've got some savings aside, you've got cash away for a rainy day. You'd
Yeah,
also want to check that your parents actually are happy to go guarantor for you. And that's a conversation, you and I have both had with clients before and
definitely.
clients' parents in terms of education. But I
Yeah.
think, yeah, 30K, parents that are happy to go guarantor, you've started
Mm.
the conversation, then let's have a chat and let's get the ball rolling.
Yeah. And is there a income number that they need to be on, or what do you think like a minimum income they should be having is for it to be plausible?
I think it depends on where you're located. If you're in, let's say, regional areas, it might be a combined household income of 130, $140,000. Two borrowers, 60, $70,000. Whereas if we're looking in, one of your capitals, that number might increase to, let's say, 180, 200,000 as a joint income to put you in a position to purchase in that area.
Yeah, that makes sense. I guess for people who are looking to rent, purchase an investment property, interstate, that number can be on the lower end, right? So I
Definitely.
think probably if you want to reach out, have like, that buffer savings, 20 to 30K at least. Have your ensure that your parents have at least some sort of equity. If you're unsure whether it's enough or their position is enough, that's a conversation
Of course.
you can have with us. Do an initial touch base with your parents on if they'd be, if they're open to it. You don't have to convince them. One thing we have is we have a document that explains, how you can educate your parents and your guarantors on what a guarantor is, so they feel comfortable with it. But just have that quick conversation to be like, hey, is this something you'd be open to? It's something I'm looking at. And then you can touch base with us. And then the final thing is combined income or income of at minimum 70K if you want to purchase an investment property, because then we can look nationally across Australia. But if you want to purchase a home, it's probably more specific to the area that you're purchasing in, which if you're in a Sydney, can be on the lot higher end. If you're in a rural town, it can be on the much lower end, right? So yeah, I think those are some good metrics, minimums to think about. And again, if you're unsure, you can always just directly reach out to us and we can help you with that. That's what we're here for. So that makes a lot of sense. The other big one over here is, and again, we're big believers in this because we've helped multiple clients with this, is not even using the guarantor to purchase your own home, but using it to enter the investment market. We're not going to talk about rent vesting in this video as there is already a really good YouTube video on the channel about rent vesting. Sound quality is not the greatest, but the quality of the content is amazing. Definitely hop on, watch that video, understand the pros and cons of rent vesting. For those of us living in more expensive markets, one of the best tools you can use to build, scale your portfolio. So yeah, that's awesome. I think we covered a decent amount about when you can use the guarantor. Let's jump next into what are the risks of a guarantor, right? So I guess the main risk that people are afraid of is they they guarantor their kid and their kid stops making payments, right? Let's let's talk about this default risk, right? Because essentially this
Hmm.
is the risk. What does that process look like, right? Little Jimmy buys a 500K investment property, and mom is the guarantor, and then little Jimmy, pisses off to Bali and stops making his payments back to the bank. What does the timeline look like on average in terms of what the banks will take, or like
Hmm.
what next steps the bank will take, and what does that look like?
Yeah, of course. Firstly, I think Jimmy needs to pay his bills instead of sinking bintangs. But if he ends up in that situation,
Little Jimmy is a bit of an asshole, but anyway, classic Little Jimmy.
I
All right,
think
yeah, yeah.
look, it's definitely when I speak to parents, it's the biggest fear. The biggest fear is that if I go guarantor, I'm gonna lose my home if something goes wrong. Now, in in practice, firstly, a bank's not gonna want to repossess a parent's home because bad publicity, right? Bad juju. Banks
Very
do
bad
everything that
publicity.
they can to preserve their rep.
Yeah,
And it's coming from someone who, prior to my broking life, I spent a lot of time dealing with clients in mortgagee and possession instances. It's one of the last things that they like doing. Now, realistically, what happens, let's say, Jimmy runs away, stops making his repayments, and is uncontactable, the bank will start legal proceedings against Jimmy eventually. Um, After they've tried to contact him, send letters, probably send people to his house, to check whether he's there. Then from there, they'll start the process of repossessing Jimmy's investment property. Now, in that instance, let's say, they've borrowed 100% of the purchase costs, right? And it's a $500,000 property. The bank has an obligation to try and sell the property for as much as they can in the current market. So previously, people would jump on mortgagee and possession sales thinking that they would get, $200,000 discount or whatever it is. That's not the case anymore. The regulators really hold banks accountable to making sure they're selling the properties close to market value. So,
yeah. It's like back in the days, the banks just didn't want to waste their time
yeah,
because they know they get their money either way. But now the regulators make sure that they're actually putting in the effort. And that's why it's like a lot of mortgage in possession properties, you'll see that they won't accept pre-auction offers.
no,
They they won't they won't like, very rarely will they accept like pre-market offers or something like that.
I
It'll
was,
have to
I
be
was gonna
something.
say, Arshad, that would suck for you because I bet
Yeah,
you would
yeah.
have
I mean,
gotten some
like
good mortgagee and possession deals back in the day.
yeah, I've actually done a couple of mortgage in possession deals for clients, and they were, renovators, so on and so forth, those type of clients. And only one of them were we able to like secure a pre-market. And even that, I was like very surprised that
Mm.
they were open to it, right? But
Yeah.
generally the banks see out the process end to end because they don't want to be liable to be like, if the regulators are like, why didn't you put in the effort that you were supposed to? They could get in trouble, right?
Yeah.
So definitely
But
something to take into
I'll
consideration.
bring us back in terms of, I guess, bank sells up Jimmy. He's got $500,000 worth of debt. After selling costs and everything, let's say the bank recoups 460,000 dollars. The bank in that situation is still going to try and pursue Jimmy for the 50 to $60,000, whether it be organizing a payment plan with him or, going after him in court or whatever it may be. before selling up the parents for 50 to $60,000 in that situation. Because when you think about it from the bank's perspective, they've got reputational risk, they've got their own costs. Is it really economical for them to sell up another property to try and recoup 50, $60,000? Um, and even at that stage, let's say Jimmy disappears, still not contactable, the bank will then speak to the guarantor, so the parents, and be like, okay, what can we do about this 50, $60,000? And in that instance, the parents, they can pay out the debt themselves, they can enter a payment plan towards bringing the debt down. It doesn't immediately go from Jimmy's run away to, oh, the next option is selling out the house. There's steps before that in terms of, let's negotiate with the parents about the remaining debt and get that sorted out. But that's way, way, way down the path. And then only then, if, it's a substantive amount, the guarantors can't enter a payment plan and every possible option has been exhausted, then the bank might then take possession of the guarantor's property and sell. But I
Yeah,
think the most
I think
important
that's
thing to recap is that the core fear of people when it comes to a guarantor being, my property is going to be sold, is so far down the enforcement timeline that it's almost an irrational fear. Like, yes,
yeah,
it's a risk, but it
yeah.
doesn't happen every single day.
Yeah. Yeah, probably hardly ever. It's a very rare phenomenon, right? So like
Mm.
if we were to summarize the steps, Jimmy stops making the payments. They try to contact Jimmy for X period of time. Do you know what that'd be? 12 weeks or whatever period of time. Then Jimmy's still not reachable. They take possession of the house that he purchased. They sell that off. If that covers all of their costs, then awesome. It's done. If it doesn't, the difference, which will probably be 30, 40, 50K, they will go to the parents and try to speak to them about, paying that as cash or even entering a payment plan. And then if the parents refuse that, which I don't know why you'd refuse that because they're giving you an option, then at that point, that's when they would claim your house, right? So there is a lot of things that need to happen before they come after your home. Uh, Having said that, make sure that anyone that you are guaranteeing in your family, your kids, your nephews, or your grandkids, whatever, make sure they're responsible and make sure they're in the right financial position to take that loan on, right? Don't just be like, oh, you know what, I'm just going to willy-nilly guarantee everyone just because they're family. Have a very serious discussion with them as they guarantor about what it means and what you're doing for them, and make sure that they're responsible enough to understand the importance of that and not put you at any inconvenience, right? I'm not even going to say risk, inconvenience.
Yeah, for sure. I think the other thing that I would throw in there that I didn't earlier is that as soon as Jimmy defaults on his loan, the bank will inform the guarantors.
Hmm.
So it's not
And then Jimmy's
until,
getting roasted, bro.
yeah, straight away, straight up. So as
Jimmy
soon
ain't
as he
coming home
defaults
for
on the
Christmas
loan,
this year.
the letter's going to the parents can rock up at his house and, fist fight him or whatever they want to do, but they'll know really early in the process that the loan's behind.
Yeah, exactly. Right. And look, if you're guaranteeing an individual who is responsible, this this shouldn't be a problem, right?
Mhm.
Like in all honesty, if that a responsible individual sees that they're going to be struggling with their loans, they should probably figure out a way to sell their property off early so that they can cover the loan or do something about it to organize that, right? But the bigger way to mitigate this risk is make sure you're not getting into a loan that you can't sustain, right? And that's why a good broker will run the numbers for you, right? It's like if you're buying a house that's like, the monthly payments are going to be such a big portion of your salary that, and you don't even have a savings buffer, can be pretty scary, right? It's like, why take on that risk? Maybe just buy a cheaper house or whatever it is, right? Anyway, those are some of the risks. Now let's jump into talking about advantages and disadvantages, which I think is, probably one of the bigger reasons we're here, right? So first advantage is higher loan amount, this is pretty much what we talked about. You don't
Mhm.
have to have that large cash savings to get into the market, which is obviously good. It's nice, right? Being able to enter the market earlier is what one of the most powerful things, right? Don't need to have that huge cash savings, which people are constantly chasing after. Second is you can avoid LMI. Well, not can, you will avoid LMI if
You
you
will
have a
avoid. Yep.
guarantor. Is this like in every single case, or is it like it depends? Or is it like
Mhm.
you have a guarantor, LMI is avoided?
Yep. So as soon as there's a guarantee in place, there's no LMI because the loan security is split over two properties.
Yeah. Okay, beautiful. And then the next one over here is in general, you will be getting the rate of a person who's at 80% LVR. Is that
Mhm.
correct in all circumstances as well?
Yeah, so that's spot on. The alternate is if you don't use a guarantor, you might have to go in at a 90% lend, so 10, 12% deposit, including LMI. Um, and the rate difference you're looking at anywhere from 0.5 to 1.2%, depending on the lenders and the time in the market. So it really is a big saving and it adds up over time. It could be several thousands of dollars every single year that you're saving purely by using a guarantor.
Yeah, I'm gonna put you on the spot, and like you can throw like random numbers or like estimates at us, but
Oh no.
let's think three different scenarios, right?
Hmm.
So scenario one, all of them is 500K purchase, right? Scenario one is no guarantor, 90% LVR,
Hmm.
right? Scenario two is no guarantor, 80% LVR, right? Scenario three is guarantor like 0% sorry, 100% LVR, maybe even 105% LVR, right? Let's just say 100% LVR to make it easy. Well, that's messy, right? So let's start with what do you right under the current market, what do you think the rate a person would get for each of these scenarios?
Hmm.
Just an
I,
estimate.
I think the 100% situation is there's only one lender that I know of off the top of my head that will
Oh,
do
sorry, this is a person who has a guarantor.
has a guarantor. Okay, that's cool. That makes more sense. So looking at the guarantor and the person with 80% lend, looking at about 6.2 to 6.4% in the current
Okay,
market.
let's say 6.3, right?
Yep.
6.3, on average, right? These are just estimates.
Yeah.
20% LVR, where's this person roughly landing at?
Look, anywhere from 6.8 to 7.1.
All right, let's say 7%, right? Again, depending on circumstances, bank they go for, etc. Right? Uh, how much cash do each of these need to enter the market? This person needs 10% plus acquisition costs, so we'll say around 75K, right? This person needs 20% plus acquisition costs, which will probably be around 125K. But this person has LMI as well, right? So it'll probably be closer
A little
to
bit more. Yeah.
85K,
Yeah.
right? And this person probably has maybe just any services that they use that the bank won't cover. So let's just say 15K, right? So 85 needed, 125 needed, 15K needed, right? Now, what do you think? Again, just a very rough estimate of monthly payments would be in these scenarios. I know I'm putting you on the spot. You usually have a calculator run these numbers, but where do you think?
Oh, look, how about I actually get us some proper numbers? Because unfortunately, unlike some of my other colleagues in the industry, I'm not a walking calculator.
Fair
Uh,
enough.
I I get the calculator to do the job for me. But let's do some brief numbers, right? So let's look at owner occupier. What's the first one? 500K
Mhm.
at 7%. So let's look at that. Oh, we're looking at about, if this wants to load for me, about 3,300, 3,400 a month.
Let's say
P&I.
3,400.
Yep.
Yeah, P&I. Scenario two,
So scenario two, we're talking what's the purchasing balance for scenario two again?
so 500K purchasing price, 20% deposit.
Mm-hmm. So let's say we're looking at 6.3, probably about 3,080, give or take.
3,080, or let's just round down 3,000.
Yep.
And then scenario one, because obviously these guys have like 100% debt, but they'll have the lower rate.
Yep. So then in that scenario, we're looking at, let's build in purchase costs and things like that. Um, Again, probably about 3380.
Yeah, so let's say 3,400, right?
Mhm.
So I think like looking at these numbers, the interesting thing for me is okay, or like the non-interesting thing is obviously the one with the lowest payments is 80% LVR, which is obvious. You have the lowest amount of debt and you have the lower rate. The problem with this scenario is you just got to save so much, right? And if your parents gift you a deposit of that amount, awesome, good on you.
Great.
But if not, you're going to be constantly saving, right? Scenario two and one and three, these are the interesting ones for me, right? With scenario three, your monthly payments is roughly the same as your monthly payments in scenario one, right? And that's because you have more debt, but you have a lower rate, right?
Mhm.
And that's really interesting to me because it's not like I think a lot of another big fear that people have is if I go with the guarantor, I'll have so much debt that it'll be so much more negative cash flow with so much heavier the payments, right? But it is roughly the same, right? Again, run the numbers on an individual scenario basis, but it is roughly the same as having a 10% deposit because you have that lower rate, right? The big advantage over here is you get into the market much earlier,
You
right?
don't have to save an extra 80K.
Right. And you have like that extra 70, 80K in your pocket, which maybe you put into your offset account
Mhm.
and you can use it for multiple uh other strategies which we'll discuss, right? So that's cool. Beautiful. Actually, I actually like that. That's a good visual representation. We have a resource which is like a short one-page PDF that breaks down these numbers, which if you're interested, message us and we'll send it to you, gives you the numbers in these three different scenarios, broken down like all the specific costs, not just the base numbers. So if that's something you're interested to see, definitely DM myself or MT and we'll send that through to you, right? Now let's come to the one that's highlighted in, or the point that's bolded, right? And I think this is the most important point, right? When you use the guarantor strategy, you enter the market a lot earlier, right? What do you think on average the timeline that people enter, like how much younger do they enter the market when they go with guarantor
Mhm.
compared to people that don't? Is there any stats around that? Do you have any just an insight into stuff that you've seen or
Yeah, look, I think in particular with housing prices going the way that they are, the gap keeps on getting wider and wider. The average first home buyer at the moment is, I think I saw the other day, it's like 33, 34 years old. Compare that to some clients that we've worked with that we've been able to get into the market at 22 years old, 22, 21. And that's 10, 12 years, right? It's a whole property cycle that
yeah,
they're able to get in earlier.
yeah, yeah. And it's like the important thing to remember with property is that compounding effect, right? So it's like you're entering 10 years earlier, you're hitting that point of inflection 10 years earlier, right? And that's the big thing, right? Hitting that point of inflection 10 years earlier is the difference between, hitting your passive income goals at late 40s or early 40s compared to hitting it at mid to late 50s, right? The difference between building a retirement plan or escaping the rat race or
Yep.
if we're doing Gen Z escaping the matrix, right, whichever term you want to use, that's the difference, right, of entering the market 10 years earlier. One is you're setting up a really good, maybe slightly earlier retirement with a really strong passive income. In the other scenario, you're literally building a strategy that you can retire at a young age and, live out your late 30s, early 40s, in a on your terms, right? Beautiful. Let's very quickly talk about some of the disadvantages uh of using a guarantor, right? Which I don't think there are many, apart from honestly just the one, which is very circumstantial. Uh, Guarantors assets at risk. We already talked about this, and again, this is very minimal risk. The procedure of them seizing the parents' assets are very unlikely, right? But it is a risk that you need to be aware of, right? Second risk is limited loan flexibility. Do you want to talk to this one a bit more, MT?
Yeah, for sure. I think the I won't overcomplicate it too much, but obviously when you're borrowing 100% of the purchase price of a property, you're going to be with that lender until you've built at least 20% equity in the property. Until the value of the property's gone up and the debt's gone down, your options in terms of refinancing or moving to another lender are pretty much non-existent because you'll trigger lender's mortgage insurance if you try to move before then. And then, what did we even do the guarantee for, right? We did it to avoid LMI. So I think from a limited loan flexibility perspective, it's just be prepared that the guarantor loan that you're with, you're gonna have to commit to that lender for, it might be 2 years if you're buying an investment property and adding, some value to it, manufacturing some equity, could be even less than 2 years. I've had clients turn it around in 6 months where they've been able to release a guarantee, which we'll talk about a little bit later. But if it's you're buying your principal place of residence, you might be with that lender for 4 or 5 years. So that lender choice is really critical.
And that's where good broker comes in, right? Like, and if you're going down the investment property, then getting something that you can get such aggressive growth early on, you can remove the guarantor and then access the equity, right?
Mhm.
And then I guess the big one, and this one is completely circumstantial, subjective, is how does this affect the relationship with your guarantor, right? Something for you to think about, something we can't even really give advice on, but it is definitely something to take into consideration. If you feel like doing this might create an awkward family dynamic, might cause family issues, might result in your parents, pushing you for a grandchild a bit more than you'd hope for. They'll be like, "We helped you get your house now," classic ethnic parent strategy. But yeah, like this is something just to take into consideration, right? Like, will this do anything awkward to the family dynamics that you don't think is worth it? And it's a completely subjective decision, right? If you feel like it's going to mess up the nature of the relationship so much that it's not even worth getting into the market a few years early, then there's no right or wrong answer. I think it's a very subjective point, but it is something definitely to take into consideration. A lot of the people that we've helped with guarantors, like obviously we have to speak to the guarantor as well, and a lot of them are very easygoing. They're like, okay, yeah, definitely want to help set up my kids. I'm not going to use this as some sort of a manipulation tactic to puppet them and get them to do all my bidding for the next 5 years. But yeah, again, something to think about. I don't think there's any point us, dragging that point out. It's just definitely something for you to take into consideration. Any interesting stories that you have around this, MT, or like all the ones that I've seen have been like pretty easy going around. Like the guarantors are like, yeah, if we can do it, sounds good, happy to help.
Mhm.
Once they're educated on what it looks like, they're good to go. I haven't seen any horror stories, but would be keen to hear if you have.
Oh, how long do you have? No, I think the horror stories come when you're not transparent about things up front. Because when you enter a guarantor situation with your parents are going to know how much you're borrowing. They're invested in your financial affairs, and rightfully so. Like they're doing something for you in terms of providing the guarantee, utilizing their property to help you get into the market. I think sometimes when I'm talking to younger clients in particular, they're like, oh, we don't want our parents to know what's going on or what the loan balances are or anything like that. But it's about understanding that they're putting themselves at risk how high that risk is doesn't really matter, but they're putting themselves at risk. And so rightfully, they should actually know what's going on. And I
Yeah,
think
I think that's fair.
once they wrap their head around it, they're like, okay, cool, I get it. Like, let's go.
Yeah. Perfect. Yeah, I think like the thing over here is if you're going to be using Guarantor, they're doing a big favor for you. You need to meet them halfway, right? Be
Yeah.
fully transparent with them, be open with them. If it comes to a point where you're struggling to make the payments, let them know. They've already been your guarantor. They'll probably help you out, right? They don't want the inconvenience of you losing the home and all that kind of stuff. At the end of the day, they are your parents, right? And if they're doing this to help you out, they will be most likely willing to help out in other ways as well. But again, definitely a point for you to think about, like how does that affect the family dynamics, right? Uh, cool. Here we're going to talk about some of the myths of guarantors, right? Some of the interesting myths that people have and the actual truth around these myths, right? So the first one being they believe they will have to be the guarantor on the property for the lifetime of the loan. We already
This one's
talked
my
about this,
favorite.
right?
This one's my favorite.
Right. So obviously, a lot of people are scared of, if I'm guaranteeing someone, I'm the guarantor for 30 years. I'm already 45. You want me to be a guarantor when I'm 75? That just sounds crazy.
Hmm.
We already talked about how this one is false, but do you want to just quickly give a brief explanation about how it actually works?
Hmm. I think two words: exit planning.
Hmm.
Most important thing when it comes to a guarantor, in particular, having the conversation with the parents or the grandparents or whoever's being the guarantor on the loan, is having a concrete plan for exit planning. In terms of practically how this will work, is that as soon as the LVR on the loan drops to 80%, so as soon as you have 20% equity in the property, you can approach the bank, or your broker will approach the bank on your behalf and just request that the guarantor be removed. It's not a difficult process. It involves, a valuation getting done on the property. If there's 20% worth of equity in the property, they'll remove the guarantee. It's very straightforward, very simple. Another thing that we can use in this situation as well, another strategy that we've executed to help people get out of the guarantee earlier, is different banks will have different valuation systems, will come back with different values for properties sometimes. And sometimes Bank A might have been great for your guarantee and getting it in the market. And then Bank B might come back with an 80% LVR valuation. And we just refinance you over to Bank B and get rid of the guarantee as soon as possible. That's another way that we've been able to get clients in and out of a guarantee a lot sooner, and definitely a lot earlier than 30 years. Typically, you're
Oh
looking
yeah.
at maybe three
There's
to five years.
0% chance you're lasting 30 years, right? It's like I'd say max would be 6 to 7 years,
Yeah.
right? Probably goal would be, I think as a kid, your goal should be 3 to 4 years,
Mhm.
pay down your debt. And again, a good broker will help you know how to valuation shop, right? Like a lot of people think a good broker is just someone who finds you the best rate, but there's so much more to it, right? And knowing when to move you to what bank, because they understand the different valuation methods is really important as well. Yeah, okay, cool. So 3 to 4 year aim for, probably tell your parents 5 years on the higher end, 7 years max, ideally 2 to 4 years. And even if you buy a property that's low growth, aim to aggressively pay off debt so that you can remove them as a guarantor, just to, it's a way of showing them that you've taken their favor seriously and you're not wasting anyone's time. Uh, that kind of moves us to the next one, right? A lot of people are like, look, if I guarantor my oldest son, then it's unfair to the rest because how am I can only guarantor one person, right? And then as a result, they end up guaranteeing no one, right? Because they're like, oh, it's just going to cause family problems because uh, Bob gets the guarantor, but little Jimmy doesn't, right? And there's a reason he doesn't. But anyway, yeah, tell us a bit about this myth and how people get around it or why it's false.
Yeah, sure. I think Firstly, tying it back to exit planning. If you've got multiple kids or multiple siblings, having tight exit planning for each of them definitely helps. The other component is that there is a few lenders who will actually allow multiple guarantees at the same time
Mm,
if all the lending is with that one lender.
mm,
And there's enough equity in that property to sustain that. So I think that's kind of the two sides of it. I think the biggest thing is that it ties into point number one, where people think that they've got to be a guarantor for the lifetime of the loan. But in practice, if there's tight exit planning, a
mm.
family member or a parent, whoever it may be, could be guarantor for Jimmy. Jimmy's done, guarantor for Sally, and just roll over and over again, so long as
Exactly.
that equity is available and there's tight exit planning in place, and essentially help each of their kids get into the market at different times.
Beautiful. Yeah. And I think that's where it's kind of like having transparency and honesty around these family conversations is important, right? It's it's kind of like you if you're not in a financial position to do multiple guarantors at once, you space it out, right? And you have an honest conversation with your oldest child. You maybe guarantor them first and you say, we're going to need to guarantor number two in 3 years. So we need you in the next 3 years, even if there's 0% growth on this property, which ideally there won't be, but even if there is, we need you to pay off at least 10%, preferably 20%, so that you can remove the guarantor, right? So then this person knows that, okay, I need to pay off X amount of dollars in the next 3 years. So I need to basically be saving that amount so I can aggressively pay it off, right? Or maybe it's 5 years or maybe it's 6 years, but just having those conversations up front will prevent one, family issues. Two, it will allow your parents to do that for multiple kids.
Mm-hmm. Quick hack: use a good buyer's agent.
Yeah, sneaky. The sneaky plug. Any referrals? No, I'm joking. Cool. Final one is these guarantors are called parental guarantors, right?
Yeah.
But it doesn't just have to be your parents, it can be other people, right?
Yes.
Is there any, I don't think there's anything super complicated around it. It'll just depend on like the circumstances. The banks will look at it from a case by case perspective. Anything interesting to know here?
So your slam dunk relatives, which pretty much you would be able to get a guarantee with no issues. Parents, step parents, grandparents, siblings. So if you've got older siblings who are like, let's say, 10, 12 years older than you or entered the market a lot earlier, they can act as a guarantor as well. And children can actually go guarantor for their parents,
That's
which we see in downsizing sometimes, especially when we're looking at, I know a lot of kind of migrant families where their kids are now first generation. They were born here, they've been able to build really good futures for themselves.
mm,
They've been then able to support their parents in terms of transitioning to retirement by using equity in their property to set them up.
mm,
Um, I think the golden goose here slash hot tip is there is some lenders, and it's a case by case basis, who might even extend this out to, let's say, aunts and uncles,
mm,
depending on the family unit situation.
mm.
But I have done a couple where we've been able to get aunts and uncles on board as the guarantor.
Yeah. So again, have a chat with him to understand if it's possible to think about if you're comfortable doing it and how it would affect the family dynamics. And like again, that's a subjective thing which we can't really help you on, but it's like, are you comfortable taking your uncle slash aunt as a guarantor or your older brother as a guarantor, whatever it is, definitely something to think about. Cool. Those are the three big myths. And I think now that like we've gone through it, like the main thing I think is just exit plan, right? If you have open, transparent conversations with your parents and other members of the family, right? You can build it in a way that everyone's happy with it and it makes sense. It's like, okay, we got three kids. I mean, if I'm thinking about like my family, three kids, age gap of 4 years between each. Gonna guarantee one, then after 4 years, guarantee the other, after 4 years, guarantee the other. Each of them can buy their first home at the age of 22, right? And then go from there, right? So it makes sense and it's just a way to go about it, right? The more shady you keep things, try to hide stuff, the more potential you're creating for family drama, which you don't really want, right? You just want to build your portfolio, buy a home, and have things easy in the rest of your life. So let's talk about a client story that we worked on together for. And obviously, this is in relation to an investment property, right? So, yeah, like, I mean, either of us could talk to it. Maybe I'll let you run through it and I'll add my thoughts here and there since you seem to be, I think you're a crowd favorite after this one. Probably I'm going to have to get you on for a few more episodes. But
Starting to
yeah,
take
tell
over
us
the
in the
channel.
comments you've been liking MT in this episode, and we will definitely get him on for more. Talk us through the story.
Let's use, obviously we've got to protect a little bit of confidentiality, so let's use
No
Ben and
name.
Jane, shall
Yeah,
we?
well,
Um,
that's as generic as you can get, Ben.
yeah, right.
Yeah.
Um, so this was a client you and I were lucky enough to help, and exact situation like this, right? There were 20, 22, 20, 24, like young couple living with their parents and looking to get ahead in terms of their wealth creation journey. They really wanted to kind of create that financial freedom by, 40 at the latest. That was the real goal for them, was how do we live the lifestyle that we want to live from 40 onwards, and how do we create that now? And the biggest thing for them is that obviously they saw around them that, they had siblings that were property investors, their parents invested in property, and for them it really made sense to go down the property route. Now, being that young, obviously they weren't on huge salaries. They were on enough to purchase interstate, which, I won't spoil too much, but we did get to that point. But when it comes down to saving in particular, they had about 60K in the bank between them. And they really came to us with the attitude of, we want to invest, we want to get into the market, and they were prepared to put that $60,000 down. They were prepared to go back to zero and completely reset. And I think by having a conversation with them around long-term planning, where did they want to go? How did they want to get there? What was the best way to achieve those goals? We we really kind of unearthed the gem underneath, which was they're happy to live where they are now in terms of living at home, and their parents would actually be happy to go guarantor for them. They had initial conversations with them, and they didn't know that it was possible for an investment property. So that was one really good light bulb moment we were able to have with them and open up some possibilities, because anyone who's, under 30, not earning ridiculous, not earning high six-figure salaries, understands saving 60K in the bank is really, really difficult. And to do that again would be extremely difficult. So we're able to attack it from the point of view of, okay, let's try keep the 60K in the bank and borrow what we can through a family guarantee loan. Fast forward a few conversations with their parents talking about, the hot topic, exit planning, and what would happen in terms of risk. And they were happy to go guarantor. They were actually happier that Ben and Jane were keeping cash in the bank to manage their risk instead of putting all their cash down. Fast forward through the loan application process, because, let me worry about that. It's boring. They were able to borrow purchase price for an investment property plus stamp duty. And then they were able to engage arshad in utilizing some of the cash that they had aside. Now, the reason why this was critical in their strategy was, they're not professional property investors, they're early in their 20s. Jane works in admin, Ben's in a trade. Knowing where to research and look for that right area that would trigger that growth and manufacture that equity isn't in their wheelhouse of knowledge, right? So they were able to utilize some of their cash, borrow the rest, and still keep about 50K in the bank. rolling into their first purchase. Arshad, I feel like I'm doing a lot of talking, but do you want to take us from, I guess, their first purchase and what ended up happening from there?
Yeah, no, beautiful. You pretty much hit it on the head, right? I feel like we're sitting around a little fire, discussing, they're like telling a little story. It's like yeah, we should have like fireside property chats or something like that. Yeah, I think you've covered like the loan segment of it, right? They they initially they wanted to build their portfolio from a lending perspective. This allowed them to keep their cash in hand, get the guarantor, and get their first investment property. Got them something, one really good growth. But now we had that chat with them as well, that since they have this cash in hand, let's manufacture equity, right? Manufacture equity is the nos of building a portfolio, right? It's that
The
accelerant.
performance enhancing drug.
Yeah, exactly, right. You're going fast and you're like, how can I go even faster? How can I? It's an accelerant, right? It like your portfolio is growing, it just causes a jump, right?
Mhm.
So they were like, okay, we have this extra cash. Let's get something like, not like a crazy renovation project, but something where we can create, manufacture some equity, right? That's pretty much exactly what we did. Got a figure out what the asset they were looking for, picked a really high growth area. Uh, and then we got a 3 to 4 bed conversion plus a cosmetic reno, spent a bit of money on that, got it up. That massively increased the equity over a short-term period. And yeah, so it's like, actually, let me put that down. So they manufactured equity, and that allowed them, that increased the property enough for them to, one, release the guarantor. Which, do you have anything to talk about how that functioned, or was that pretty simple? Was it just like,
Very straightforward. Once that bedroom conversion was done, obviously the value of the property increased a significant amount, especially because four bedders were going for a fair bit more in that area. So it was just a matter of getting a valuation done with the bank, and off we went. They were happy to say that it was below 80% LVR, and bang bang, guarantor was gone.
yeah? And I think we got to they chose getting into the market at the right time, because obviously 3 to 4 bed conversions that don't require extensions are quite hard to find, right? Like, pretty, like, just for those watching the video, they're like, well, easy. Now I'm gonna go do this. They're actually pretty rare to find 3 to 4 bed conversions that don't require massive structural work to the property. And given how hot the market is right now, it's even harder, right? So it's like,
Mhm.
good on them getting in early, getting something that could do a 3 to 4 bed conversion at that time, without any major structural work to the property and the extension, so on and so forth, as well as basic cosmetic reno, carpets, paint, all that kind of the jazz, bit of the kitchen, etc. Right? Release the the guarantor. Parents was really happy that it was done so fast, right? That they no longer had to guarantor the property. What was it? I can't remember the time. It was like 8 months, a year, or something like that. It was pretty quick, right?
It was
And
very
now
quick.
then purchase the second property, went something lower risk for that one, more like a buy and hold, good yield, slightly newer, and that's been growing well as well. And now they're pretty much in the headspace where it's like, okay, we're a year and a half in, close to 2 years in. When can we
Mhm.
pretty much purchase the third, right? And
Yep.
in all honesty, probably in the next 6 max 12 months,
Mhm.
right? Equity on the first one has gone up, rent on the first one has gone up, equity on the second one has gone up. Now it's salaries for them have gone up as well. Since, when you start your career pretty early, like in the early stages of your career, your salary goes up pretty fast, right? And then obviously it plateaus until the next big jump, right? And they're staying at home, so they're pretty aggressively saving, keeping that in their offset account. And they're like, now they're in the game. They're like, when
Yeah.
can we third purchase, right? It's almost like it's an addiction, right? Third, fourth,
Mhm.
fifth, eventually pivot into starting to buy commercial, so on and so forth, right? But long story short, they got into the market early, which is the biggest thing, right? They're going to build a good diversified portfolio with a strong set of professionals around them. And then from there, they're going to pivot into investing in commercial high cash flow assets, and hit that goal where somewhere in their 40s, they're kicking back, they've reached quote unquote financial freedom, or what they've defined as financial freedom to us, right? They're the ones who set those numbers for us, and we aim to reach those goals if they're reasonable, right? My philosophy is if someone comes and tells me an unreasonable goal, I'm just gonna tell them that's not a reasonable goal. Let's
Exactly right.
reset, have reasonable goals, right? But the biggest thing they did is enter the market early by leveraging this uh, thing that's available to them, right? Again, we understand that this is not available to everybody, and that's fine, right? Like, I mean, I'm like an international, right? I came here. I'm not born and raised in Australia. It wasn't a strategy that was available for me, but I had to find other ways around things, right? So it's not going to be available to everyone. That's fine. There's other ways to do things, getting into rent vesting, other strategies you can use. But for those who do have this as an option, it is definitely a really good option to use, because if you do it, you can build a good enough portfolio that in the future you can be the guarantor to the next generation of people in your family, right? Your kids, your nieces and nephews, so on and so forth. Uh, yeah, there was one more point that I wanted to make, but slipped my mind. Any questions, any thought? Like, do you have anything to add over here? Like, I think it's a good client story, whether you're early 20s, mid 20s, late 20s, even 30s. If you haven't purchased your first property, it's definitely an option to look at.
Yeah, I think it's it's a really good way to just show the power of time and using the right lending strategy and purchasing strategy hand in hand. You know,
Yeah.
these guys entered the market 10, 10, 12 years earlier than the average first home buyer. And by the time they're the age of the average first home buyer, they're probably going to have 4 or 5 properties under their belt, depending on, you know, their goals and their circumstances.
Yeah.
And I think the most powerful thing that you touched on, Ash, was besides kind of living the life that they want to live in their 40s, I think leaving a legacy is
Mm.
really, really powerful in terms of setting up that living the life that you want to live, but also being able to set up the next generation to do something really powerful and not have to go through the struggle that you know you would have to build up that portfolio and get into that position. I think that's something that's really powerful about property investing in general, but also just being able to start really young with a strategy like this.
Yeah, it helps you build your community. I think the point that I wanted to mention, which slipped my mind, was these two, again, fake names, Ben and Jane, are pretty much like, what we would call middle class Aussies, right? They're not from
100%. Yeah.
like their families are like, like not like crazy well off, but like again, middle class.
Mhm.
They have like one's a trade, one's like, working in administration. They're like very much middle class family on middle class salaries, and they're building a large portfolio, right? So it shows that this is something accessible for a large amount of people. And even if you're from like, that middle class, you can find a way to make it work, right? Whereas a lot of people think this is property investing is something solely for the top 1%, top 5%. Obviously, if you're in the top 1 to 5%, you can do things a lot faster because of your earning capacity,
100%.
the structures you have around you. You can build like it's the difference between like, building a $50 million portfolio versus building a $5 million portfolio. But at the end of the day, if you know what your goals are, and a $5 million portfolio generating 150K, 200K of passive income is your goal, then why not, right? Like, there's nothing wrong with they like that's a great thing to achieve. If someone from a much higher income has a much bigger one, that's up to them. Leave that to them, right? So I think like that's a really big point that I want to hit home is it is something that like property investing and the guarantor strategy is not just limited to the 1%. It's something for all of us to look at as an option. Cool. So now sorry, anything you want to add there before I jump into tying off the video, next steps?
No, all good, man. I think you hit the nail on the head. That it's real people doing real things that are really powerful,
Yeah.
and it's achievable.
Yeah. Beautiful. Love that. Okay, cool. Next steps, keep engaged with us. We're gonna keep putting out awesome content. Like, subscribe, comment, tell us if you want Imti on another video. I think it was really good, so I'm keen to have him back for more. if you want to run the numbers, whether it's related to the guarantor strategy or just investing in property, getting a loan, just anything related to this, reach out to myself, or you can directly reach out to IMTI. If you reach out to myself, I'll do some of the numbers, but then when it comes to the point of the finance, we'll connect you to IMTI. Plan out your portfolio. We can sit down with us. We'll help you plan things out as well. And then speak to your potential guarantors if it's something you're looking at. Have that soft conversation with them. And we have a document that we can send you as well, which will help you explain to them what a guarantor is and how you can risk mitigate and just basically everything we covered in this video summarized into like a nice one pager. This is how it works. These are the risks. This is why it's not as risky as you think it would be. This is how you can guarantee multiple family members. Pretty much everything we covered in this video, and that's pretty much it. And from there, just execute on your strategy, keep building your portfolio, and hopefully we can be there to help you throughout that. Right? Imti, anything to add?
All good, man. Thanks for having me on board, and always love having a chat with you.
Beautiful. All right. Thanks, everyone. Again, like, subscribe, follow. I feel like I need to change this final slide. It's super generic, but that's something for my designer to look into. And see you all in the next episode. Bye.